Hello, good afternoon, and welcome to today's episode of Modesty's Money Masterclass. This is episode number 34, and I remain your man, your host, Ikenna Umezudike, the director of Modesty Financial Consultants Limited, financial services company based in Luton, United Kingdom, specializing in mortgages, financial advice, investments, advice and financial consulting, business loans. So today we are going to be continuing on the series we started last week, where we're discussing understanding and improving your credit score. This is part 2 that series. So last week we spoke about your credit score, what a credit score is, what credit reference agencies are, and we discussed the components of your credit rating, where it is categorized as very poor, fair, good, and excellent. We discussed also the components of your credit score, your actual credit score, what does it contain, and we talked about your personal details last week, and we talked about your ratings as well, how you're rated. And today we're going to be talking about accounts. On your credit score, there is a section there devoted to your account. So we're going to be discussing those things that are contained in that account. So in the section where it discusses your accounts, basically this is where all the accounts that you have, and all the accounts that you're paying, the status of the account, the history of the account, how you've been making payments into the account, and all the credit commitments you have. All of them will show in this section termed the accounts. Now, this section also contains the details of all your active, your settled, and all your default accounts. Your active accounts are the accounts that you are still actively managing, paying into, that are still active and live. Your settled accounts are accounts that you have paid off, or accounts that you have, bank accounts that you have closed, or accounts that you have reached a settlement agreement with the lender and you have lived up to that agreement, and it has come to that time and it has closed, you've settled it. Okay? And then the default accounts are accounts that you have defaulted on, or you have missed payments on, and it has gone into a default notice. So the more settled. Hi Joy, good afternoon. Thanks for coming on. The more settled accounts you have on your credit reports, the better your credit report is. So basically, those settled accounts are an indication that you have been opening accounts and you've been settling them, right? And you've been settling them amicably. You've reached agreement with the lender. So it's a good thing to have on your report, that you've got lots of settled accounts. So the more settled accounts you have, the better for your credit report. Likewise, the more defaults account that you have, the worse for your credit report, because it simply means that you don't live up to your credit commitments and you don't honor your credit agreements. Okay, so now with respect to default accounts, I have a piece of advice for you. Whenever you default on your account, the lender or the credit agreement, the people you have the credit agreement with, what they will do is that they will write you a letter, and on that letter it will be notice of default or default notice, basically notifying you that this account you have with us, you have defaulted on your payment on that account. So they are inviting you to rectify that situation on default. So that is the moment you've got to take advantage of. Taking advantage of it in the sense that you have to get hold of the lender or this company and say, okay, what do I need to do to bring this account into up to date again? And they will simply say, this is how much you need to pay to bring the account up to date. If you can afford to pay that amount, pay it at that point in time and bring the account up to date. If you cannot afford to pay that amount at that time and you are struggling financially, you can enter into an arrangement with the lender and say, okay, listen, I'm struggling financially now. I can't afford to pay this amount, but I can afford to pay this much. Can I make this part payment and then I'll pay the balance? You come to some kind of arrangement. Lenders are always more favorably disposed to positive discussions and conversations with with borrowers, if you are going through a difficult situation. The worst part of it is when you ignore those letters and you count them as nothing, and then that default notice, they'll keep sending you that default notice, and then when you keep ignoring, they will just go and register a default on your credit report. Now, the default notice letter the lender will send to you, as long as you go you go as far as settling that dispute at that time, or that default at that time, a lot of the lenders will not register a default notice on your credit report because you have been reasonable, and they are reasonable as well. But it's only when you keep ignoring those letters and those invitations to settle this thing, then they can register a default notice on your account. And each default notice registered on your account stays on the account for 6 years. Okay, so for the next 6 years, that default is registered. Anytime you go to obtain a credit, because of that default, you may not get a credit from a high street bank. The high street bank might lend you money, but they will place you on a different interest rate category depending on how much defaults you've got. So it doesn't mean that you will not get credit, but you may not get the kind of credit that the other person will get, somebody who has managed their affairs properly, and you may not get it at the interest rate that they get, or you may not even get a credit at all from a high street bank. So you might have to resort to specialist lenders. Okay, so according to the Consumer Credit Act, these lenders are supposed to send you a letter of a default notice and invite you to come and resolve this thing. And as long as you take that invitation and you resolve it, you are good to go. So at that point in time, it's very important that you engage the lender and get that sorted. So I mentioned that most lenders are willing to work with you, and they find a solution to resolving it. Now, there's something that happens regularly with people, a common excuse on why they have had default on their credits and all that. And that common excuse is moving home. I've come across clients who say to me, "Oh, Iken, I had this default because I moved home." And then the lender kept sending letter to my previous address, and I didn't get hold of the letter on time, and I defaulted. Listen, if you move home, hi Chika, good afternoon, thanks for coming on. If you move home, the best thing you can do is redirect your mails. Go to Royal Mail and redirect your mails to your new address. It will cost you money. Pay for the redirection of that mail from your previous address to your current address. That way you will not miss out on any mail until you now finally switch over your address details to all your lenders or to all the people you have credit commitments with. So if you think it's going to take you 6 months to move your address details and update your address details with all the people you have credit commitment with, then redirect your mail for 6 months and pay for 6 months redirection of mail. If you think it's going to take you less than 6 months and within 3 months you should be sorted, then redirect for 3 months and then you pay less, right? But the important thing is that you redirect that mail so that you give yourself the time to be able to move your address details and update them with everyone that is concerned. When you do that, you do not stand the risk of missing payments or defaulting on payments because you've moved home. Otherwise, it's going to negatively affect your credit report. The other thing you need to do basically is to make sure that every credit commitment you take out, you have set up a direct debit. Direct debits are the best ways to manage your credit commitments. That way you will not miss out on any payments and you do not stand the risk of defaulting. And when you are setting up the direct debit, set them close to when you're getting paid. Because if you're getting paid on the 28th, set your direct debits to come out on the 29th. If you're getting paid on the 27th, set it to come out on the 28th. So that as you're getting paid, your credit commitments are going out of your account straight away. And when all those credit commitments have gone out, you exactly know how much funds you have left. Your disposable income becomes clear to you. It helps you with your budgeting because then you now know what is going out and when it's going out and when and how much you've got left. Do not leave it too far away from where you're getting paid. Otherwise, if you're not very responsible with money, you get paid on the 29th and you set your direct debit to be coming out on the 12th of every month. and between 27th and 12th, a lot of things have happened, and you have visited a lot of restaurants, you've done a lot of shopping, you've paid some money that you don't really, because then you got this money in your account and you think they all belong to you, and then all of a sudden you've forgotten that there is actually something that you need to pay for and which you need to set up a direct debit for. But if you set up a direct debit close to when you get paid, it saves you that stress. Manually managing your credit commitments are not usually the best, because if you think, okay, I'm going to be making transfers each time I get paid, there's a likelihood that you will be either be reluctant to make that transfer when you get paid, or you forget. It happens. Okay, sometimes you're so attached to your money, and when that money comes into your account, and you'll be like, how can I transfer this money? Let me just delay it a little bit. I mean, the reluctance to pay money is not there because you haven't got the discipline to do it. So the best way to discipline yourself financially is set up direct debits close to the time you get paid, and it helps you manage your credit commitments better. Okay, and then remember, the details on your credit commitments are limited to only your 6 years financial history. Whatever is older than 6 years does not appear on your credit reports, and that is basically what the high street lenders are more interested in. They are more interested in what is on your credit report within the last 6 years. Anything that happened outside of 6 years doesn't really affect your credit report. So in that account section, you see things like hire purchase agreements, like loans, bank accounts, your credit and store cards and all that. So let me just try and piece these elements one at a time to help you understand how these things are viewed and how they are worked on your credit report. Now let's take hire purchase agreements and loans. Now, hire purchase agreements are things like your car finance agreements, or the finance you took out to buy things, that are really secured on that particular item you bought. Some people go into hire purchase agreements for things like wardrobes, sofas, tables, their cars, and stuff like that. The loan or the credit card is attached to something that's material, that particular car or table or wardrobe or sofa, those things like that. It might be on a hire purchase agreement, or it might just be termed as a loan. All right, but they are just attached to something in particular. And then that hire purchase agreement, especially when it has to do with your car finance, it might also be a case of you are hiring it, meaning that you don't actually own the car. All right, so there are different ways you can finance it. You are either hiring that thing, meaning that you don't actually own it. By the time that credit agreement ends, you are required to return that item. It might even be your washing machine or your dishwasher, so you are paying a fee for the luxury of using that item, maybe your car or your washing machine or your TV or whatever. It means that when the agreement term ends, you are expected to return that item to whatever company that financed it, and then the company can either resell it after that, or they will give you a final settlement amount that, okay, if you want to own this thing permanently, pay this amount at this time and then you own it. So when you are taking a car finance agreement, for example, find out what sort of agreement you are entering into, whether you are going to own the car or you're just going to pay a higher purchase fee on it, and then at the end of the term, if it's like 4 or 5 years term, you'll be required to return it. So find out whether it's you're going to own that particular item, or you are required to return it, or there's a final settlement amount. If at the end of the term of that loan, you now decide to keep it, you say, okay, I want to keep this thing. This is the final amount I'm going to pay, and then I'm going to keep it. So it becomes an agreement. So hire purchase agreements and loans, they are similar in terms of the way they are looked at and the way they are managed on your accounts. Now, for hire purchase and loans, details like your date the account was opened, like the date you took out that loan or that hire purchase arrangement. You see detail like your payment amount. If you're paying like £150 every month, it will be there, and then it will tell you for how long you are expected to pay it. So if it's for 4 years, you might see things like 48 months, because lenders express the term in months, because you pay, that's the frequency of your payment. If you pay it in months, they will express them in months. And then you see things like the loan amount, and then the date of the last update on the account. Your credit report will show the date of the last update on the account. Hi, Ifeanyi, good afternoon. Thanks for coming on, brother. So you see the name of the credit holder, which is you, making sure that you are the one who's taking out the credit agreement. And then you see the address where that credit was registered, and then your date of birth and all that will be displayed on your credit report, beside that loan or that hire purchase. Now, it's very important that the address it was registered on is also correct, because the address that your credit commitments are registered on are very important. When lenders are assessing your credibility and your affordability, they are looking at the address where your credit commitments are registered. Is that the address where you live, or is that a different address? If the address you are using to apply for a particular credit, in this case, if it's a mortgage, for example, you're applying for, and you're using a different address, and that address does not correspond with the address where your credit commitments are registered, the lenders will ask a question. They would want to know, why are your credit commitments not registered at your current address which you are using to apply for this credit? So it might be a case of, you are living with parents, and then your credit commitments are addressed to your parents' address, which is, you used to live there, or that's where you receive your correspondence and your mails. And then you are living somewhere else, which is maybe your permanent residence, and then you want to apply for credit there. So they want to understand the relationship between that address and this, and why you are not using your current address. If it's your parents' address, it's allowed, that's fine. But there has to be that clarification on why you are applying with a different address, and then your credit commitments are registered at a different address. Because as far as they know, that is where you have more affiliation, that address where your credit commitments are registered. And if somebody lives in an address, and there's been a lot of fraudulent activities going on that address, and people are using that address for fraud and for fraudulent credit applications and all that, it's going to affect someone who's living there using that particular address to apply for credits. You notice that if you're living at a particular address, even though personally your credit report is fine, but that address and the history of that address could be affecting your credit applications, because some things might have gone wrong on that address. So lenders are very keen on the address where your credits are registered. Okay, on that account, you also see things like the name of the lender and the nature of the credit, whether it's a hire purchase or a personal loan, a car loan, whatever it is, you see it, and the nature of the credit will also be displayed on that account. And then when you go further in those accounts and investigating that further, you see things like the payments and the loan terms, which I've mentioned. Like if you're paying £150 a month, you see how long you are committed to that. If it's 48 months, that's 4 years. And then it will now tell you how much longer you have left to pay off that loan. When the lender looks at your credit report, they know how much longer you got to pay off that loan. There are certain credits that when you are close to the ending of that term, the lenders might want to overlook it, in terms of if they want to take into consideration your credit commitments. Because when you're applying for something like a mortgage, the lender wants to know how much longer you have to pay other credit commitments before you even pay the mortgage, because those credit commitments has to be paid anyway. That's why they are called committed expenses. It means you are committed to them, you are bound to be paying them. So they will be looking at that. And if you are applying for this mortgage and this is June, and you have a credit commitment that will be paid off, say, in August, so it means you just have 2 months to pay off. The lender can overlook that and say, okay, well, it's just 2 months to go, and he will be off this commitment. Okay, so that term is also important to the lender now. Now, every monthly payment you make is registered against that particular loan and that credit. And it will be, if you look at your credit report, like if you're using Experian, you see zero, it's identified by zeros. So the more zeros you have on your credit report against a particular loan account, it means you are treating and you are managing that credit, credibly. So, but the moment you start defaulting or missing payments, those zeros start changing to numbers. You start seeing things like 1, 2, 3, and all that. It starts indicating the moment from which you started defaulting or missing payments. And when lenders look at your credit report and they see those numbers, they can tell, exactly how long you've defaulted on an account. So the longer that default period is, the worse your credit rating becomes. So every monthly payment you make, it's registered on your credit report, and then it's your credit amount, your loan amount start decreasing. If that loan amount is an interest only, it will not decrease. The amount will not decrease, but it will show that you've been making payment, but the capital will not reduce. But if it's a repayment loan that reduces the credit, the capital and the interest, the amount will be reducing as you make each payment. Okay, now at the bottom and at the body of each loan account, you see those numbers 0, 1, 2, 3, depending on each payment you make is 0. Each payment you make is 0. All right, but when you start defaulting, the numbers keep changing. So, and remember, on that loan account, the activities you will see are only activities that cover the last 6 years of you managing that account. If the loan has been settled, the report will indicate that the loan has been settled, and it will show the date that loan was settled. Now, business loans do not show on your credit reports unless you are a sole trader. Because if you're a sole trader, you have taken that business loan in your name. The business is in your name. If it's a limited company account, the loans that the company has taken does not show on your credit profile, even if you are the sole director of that business, because you are distanced from the business. The business is, on its own. It's a different legal entity from you. Now, what about mortgages? Mortgages that show up on your credit report, they will contain the same information as the hire purchase agreements and loans, in terms of the time of the loan, the name, the date of birth, the address it was, and all that. And then every mortgage payment you make goes towards reducing the balance on that mortgage. So if you have taken an interest-only mortgage, like we said, the balance will not reduce. The capital will not reduce, but the payment will be registered, and it will show that you are making payments. Because it's an interest only, all you are paying is just the interest. The capital remains the same. So when the lender looks at it, they will see the capital amount. That's the outstanding mortgage you still have to pay over that period of time. But if it's a repayment mortgage, as you make payments, the capital will start reducing, and as you look at the credit report, you see that the capital is reducing. Now, I want to make you aware of something for mortgages. If it's a repayment mortgage and that mortgage is in its early years, you will notice that as you make payments, it will look like the capital is not reducing by much. And you'll be wondering, does it mean that I'm not paying this thing off? Or does it mean that, they're not applying these repayments correctly? No, they're applying the repayments correctly. But the thing is that in mortgage payments, the early years of the mortgage, usually the payments you make in the early years of the mortgage goes towards paying off a chunk of the interest. The capital, only a little bit of the capital is paid off in the early years of the mortgage. Then the older the mortgage gets, the more they start apportioning your payments to interest and to capital, paying off the capital, and then less to interest. So the older the mortgage, the more capital you pay off, in terms of they now allocate more of your payments to capital than they allocate to interest. But in those early years, you notice that it will look like the capital is not even reducing at all. So if you find that on your credit report, do not be alarmed. They are applying the payments you're making. It's just that the mortgage is still in its early age, and not much capital is being paid off at that point in time. So it is then wise for you to make overpayments on your mortgage if you can afford to. So if your mortgage is say £900 per month, you can decide to pay like £1,000 every month deliberately, subject to the early repayment charge conditions anyway. Some lenders will allow you to pay off some part of your mortgages early. Most lenders will allow you to pay at least 10% if you want to pay off 10% of the outstanding mortgage balance. So if your mortgage balance outstanding is £200,000, they can allow you to pay off 10% of it, like £20,000 in a year, if you want to pay a chunk of it off. So if you want to build that, factor that into your monthly repayments, you make sure that whatever you are paying extra, by the time the year ends, it does not amount to more than £20,000. Or if you want to make bulk payments, to reduce your mortgage, you can as well. But check with your lender and make sure that you can pay off your mortgage early, and check out what the conditions are, right? Or look at your mortgage documents or mortgage deeds. They will all be spelled out in your mortgage offer letter. But if you make overpayments, and if you're allowed to make overpayments, and you make overpayments, what it means that you're reducing the capital early enough. Because of those overpayments, they go towards paying off some part of the capital, and then you find out that you pay off that mortgage earlier than you have scheduled to pay it. Okay, now if we look at credit cards, which are another item that you can find in your account section, credit and scorecards, I'm going to do them together. Credit cards are basically credit card that you've taken out with a lender. You can spend money on it. They've given you some money on that card, right? There's what they call credit limits. So you might take out a credit card with, say, £500 credit limit. It means that's the limit on the card that you've got to spend. So whatever you're spending, if you go over the limit, you get penalized, right? So, but that's your spending limit. Then the store cards, things like Argos cards, Debenhams. Some shops or some stores have, they've developed cards for their customers. So when you take that store card, you are allowed to spend that the money on that card, but only in that store. So if you have a Debenhams card, they will give you, like, say, £500 credit limit on a Debenhams store card. You are allowed to spend up to £500 on that card, but only in Debenhams store. You cannot walk outside of that store. If you're trying to use to purchase anything online or pay for it anywhere else, it will not work. It will only work and be applied to that. So that's why it's a store card. So a lot of shops and stores, they have built a store card for their customers. Hi Suleiman, good afternoon. Thanks for coming on. All right, so you are only allowed to spend that money in that shop or on that store. So, but with credit cards, you can spend them anywhere as long as you have a card payment facility either online or in that store. So with credit cards, they have the same details basically that the hire purchase agreements and loans have, except that the loan amounts now will be replaced by credit limits. So your credit account section, it will show your credit limits on there. That credit limit will now tell you how much you've got to spend on that credit card. Now, as long as you are making the minimum payments, when you receive your credit card statement, it will specify your minimum payments for that period or for that month. So if your minimum payment is £10, and you've set up a direct debit with that credit card company to be taking the minimum payments, as long as you're making that minimum payment, that's fine. You are fine with your credit reports. Yeah, it doesn't negatively affect your credit rating because you are making that minimum payment. But then you also have an option of paying more than that minimum payment. And when you pay more than that minimum payment, you are paying down more of the interest and the capital that you owe, and you will pay off that credit card quicker if you have intention of doing that. So the minimum requirement for you is to pay the minimum, make the minimum payment. As long as you make the minimum payment, the credit card company, they are fine with that, and the credit reference agencies are fine with that. Every payment you make is registered against your account, right? To show that you're making that payment. So paying your minimum payment means that you are going to pay that credit card for a very long time. That's the truth of the matter. If you are just making minimum payments, because credit cards are revolving credit. I'm going to come to that. They are revolving credit. So if you just keep making your minimum payments, it will take you ages trust me, to pay off your credit card. And the funny thing is that it takes you a millisecond to max out your credit card, but then it takes you ages to pay off that credit card. When you spend an amount on your credit, when you spend that amount on your credit card, yeah, the time it takes you to clear that off or to pay off whatever you spent on that credit card, if you're only making minimum payments, you will not believe how long. And this is where lenders and credit companies make a lot of money, credit cards, because the interest rates are enormous. You know, they make a lot of money on that. And the longer you pay it, the longer you spend paying it, the more money they make. Okay, because at the end of the day, it means that you are just paying it in accordance with the astronomous credit interest rate that have been applied on there. And you'll be amazed at how little, you know, that credit limit is reducing if you are just making the minimum payments. So for credit cards, there's something also very important for credit cards. How close you are to your credit limits in terms of your spending also affects your credit rating. If you have a credit limit of £500, for example, and every time or regularly you are always close to that, maybe your outstanding debt on the credit card is £495. So out of the £500 credit, you have spent £495 out of that. That's how it means you just have £5 left unspent on the credit card. And the longer that remains the case, the poorer your credit rating will be. Because what it means is that you are over reliant on credits. That's what the lender is saying it. Oh, this guy, without this credit, he will not survive. So it means that his income is not enough to look after him. Meanwhile, yes, you have your credit card, you're managing it, you're paying your minimum payments, but then how much of the credit limits, how close are you to that credit limit, right? Now, some credit reference agencies will say if you maintain, if you are on 50%, if you're on less than 50% of your credit limit, that's a good sign that you're not over-reliant on credit. Some other credit reference agencies, the likes of Experian, would say 20 to 25%. Yeah, say for example you have a £500 credit limit, and then you've spent £100 out of that. That's about 20% of that money that you've spent. That's what you're owing. That's your outstanding credit on that, right? That's fine. It means that, you know, you are not dependent on credits at all. In that credits, that £100, you're paying it gradually, and you can manage it effectively. But then, if you have spent like £250 out of the £500, that's about 50% of that, or £255 out of that, that's more than 50% of that. To some credit reference agencies, that's a little bit too much. That's above average. To some credit reference agencies, that's okay, as long as it's below £250. Okay, but if the bottom line is that the lesser, the better. Okay, the further away you are from your credit limits in terms of what you are spending, the better you are portraying yourself as somebody who can manage their credit. If you can afford to pay your credit, the whole balance off every month, that's even better, because it means, okay, I've dipped hand into this credit card after I was paid because I needed to sort something out quickly, and then I sorted that thing out. My money comes in, my payment comes in. I take money from my wages and I pay that off. I spent £100 out of that £500. The moment I'm paid, I get £100 and I pay that off. What it means is that in the next statement you are going to get, you will not pay interest on that, as long as you pay that outstanding amount off before the next statement comes in. If your credit card is online, if you can view it online, you will see when your next credit statement is due. So if you pay that off before the next credit card statement is generated, you will not pay interest on that £100. It means you spent that £100 but no interest on it, and you've paid it back. Okay, so when you pay it off matters. As long as you pay the outstanding balance off before the next generation of your statement, you will not pay interest on that, because that's what it covers. So you can actually use credit cards wisely and intelligently to sort things out without paying any interest on it, because it is the interest that the lenders are living off of. But the funny thing now is, when some lenders, when they realize that you are paying off your credit card every now and then, some of them might even withdraw the they withdraw the credit card from you, because as far as they are concerned, you're a bad market. You're not making them money. They're not making money off you. You're just living off the credit, and then you're paying it off. So they will be like, this guy can look after himself, doesn't need this credit card, and we are not even making money off him. They will either reduce the credit limits, or they will withdraw the card completely from you and say, okay, let's have our card back. You go and sort yourself out. Okay, so some lenders don't like it when you don't pay interest on that. But then do what is in your best interest, not in the best interest of the lender. So if it works best for you to pay, if you can afford to pay off any outstanding credit before the next statement is generated, do that. Now, credit cards are useful in credit building. If you want to build your credits, for example, you are new to the UK and you haven't got any credit, take out a small credit card that has a small credit limit. Or you haven't taken out, you never had credit before and you want to build your credit. Because in this country, your credit reports is your credit history. The idea is to know how well you've been managing the other credits you've taken out. So if you haven't borrowed before, to them you are high risk. So they want to see, have you ever borrowed money before? And if you've borrowed, how have you been managing it? All right. So if you can demonstrate that you've borrowed before and you've been managing it well, thumbs up for you. Then other lenders will be, more favorable to lend to you. So you can take out a small credit card, say £250 credit card, and then spend money out of it and then be repaying it. All they want to see is history of repayments on your credit report, and then that's all they need to see. So it's good for credit building. The other thing about credit cards is that they are revolving credits. Now, revolving credits are credits that they don't have fixed repayment amounts, and they don't have fixed term for repaying them. So it's not like a loan that you have to pay it off within 5 years, and this is the amount you are paying off. You are paying off each month. So credit cards, the repayment amount fluctuates, the outstanding balance fluctuates depending on how much you've paid and depending on how much you spent. So that's why they are revolving credit. So you can dip your hands in and out of that credit cards at any time. But when loans and hire purchases are disbursed, once you take out a loan of, say, £5,000, you get £5,000 paid into your account, and that's it. How you spend it is up to you. And once you get that money disbursed, paid into your account, the interest rate starts counting the moment you get that disbursement. So whether or not you spent that £5,000 loan, you pay interest on it. But credit cards, you only pay interest on the amount that you have spent. Okay, that's the difference between credit cards and loans. It's only the amount that you spend that you pay interest on. So if you have a £500 credit card, and that's your limit, if you haven't spent the £500, you will not pay interest on £500. But if you spent £250, you will pay interest only on £250. And that's why it's a revolving credit. So if you pay that £250 of no interest payable on that, that's it. So you only pay interest on what you own. That's the difference between credit cards and loans. It's a revolving credit, but loans and hire purchases and mortgages are fixed term credits with fixed payments and fixed period within which you have to satisfy that payment. So that's how credit cards run. And for the sake of mortgages, right, if mortgage lenders are assessing your affordability and your credibility in terms of paying off the mortgage, they will look at your credit cards and see how those credit cards are being managed and how you manage them. And then the mortgage lenders, if you have outstanding credit card and they are assessing your affordability, they will take out the total outstanding balance on your credit card, and then they will take 3% of that as what should be your credit commitment every month. So some mortgage lenders will take 3% of that and use that to assess your affordability. So if you have £2,000 outstanding credit limits outstanding credits, outstanding payments on your credit card. Say you have 3 credit cards, and on those 3 credit cards there are £2,000 outstanding to be paid on there. The mortgage lenders can take that when they are assessing your affordability. They can take that £2,000, and then 3% of it is about £60. So they can work out that, okay, your minimum payment on these things is £60. That's what you need to pay off every month. So they can build that and factor that into your affordability to see how you can afford the mortgage that you are taking. So it means that before you pay your mortgage, you must at least pay a minimum of £60 to service your credit cards. Okay, so the last thing I want to talk about is your bank accounts, which is also an item that you see on your account section on your credit card. Now you see bank accounts that you have opened, basically, especially with high street banks. The significant thing on bank accounts is overdrafts. If you have overdraft facility on your bank accounts and you are using them, they will show on your bank account section that this is the amount of overdraft that you have used. Unlike credit cards, overdrafts are revolving credit facilities, right? You can take an overdraft of £500 if it's an approved overdraft. There are approved and unapproved overdrafts. If you go over your account and your account enters overdraft and it's not an approved overdraft, the charges from the bank are different than when they are approved overdrafts. So the lenders will look at the amount of overdrafts you have on your account, and they'll check for how long your account has been overdrawn. The longer your account has been overdrawn, the more you are sending a message to the lender that, look, it looks like you are relying on overdrafts to live. So it means you are not liquid enough. But if you take an overdraft, if your account goes into an overdraft and then money comes into your account and it pays off the overdraft and your account remains in the positive terrain again, then that's fine. So the longer your account remains in the positive terrain, the better picture you are painting of your credit ability and your ability to take out credits. So do not allow your account to be overdrawn for a very long time. Some people are, they said, oh, I have overdraft, let me use it. Well, it's there for me to use. That's fine. Some people have innocently been doing this and leaving their accounts with overdraft. It's not that they cannot afford to pay off the overdraft, but they're just saying, the thing is that let me use it. I'm not in a hurry to pay it off. But somehow it might hurt you when you're applying for credit and your account is consistently overdrawn. So it will do you a whole world of good to make sure your account is in a positive terrain all the time and not in the negative. So as soon as you can afford to pay off your overdraft, pay them off. Now, for example, for mortgages, your overdrafts don't really determine whether or not you get a lot of lenders, they waive overdrafts because they know it's a revolving credit facility. As long as you're earning money and you're getting wages paid, they know you will pay off the overdraft. It's just that, but they will require an explanation anyway. They will say, why has your account been overdrawn? And if they look at how you've been managing your bank account and they know you are liquid, it's simply that you've overlooked. You can just say, well, I thought the money was there and I was just using it, really. And then you're paying charges on it. So it doesn't make sense paying charges on those overdrafts simply because they are there to be used. The charges are accumulating on a daily basis. So as soon as you can afford to pay it off, right? So your overdrafts are the main focus in your bank accounts when the lenders are looking at it in that section. But if you haven't got overdrafts, your bank accounts are fine, they're always positive, then that's fine. Okay, guys, I'm going to draw the curtains here, and I hope it's been useful again for you today. And next week, we're going to talk about other areas of your credit report as well that we need to talk about. All right, so this is part 2 of the credit report and understanding and improving your credit. If what we have done or what you've heard or what you've watched is useful to you, please leave us a message, leave us a thumbs up, leave us a comment, let us know how you feel. Like us on any social media platform or any platform you're watching us. We are on YouTube as well. A lot of the things that we have done in the past is on my YouTube channel. Go to YouTube, search out my name, Ikenna Umezudike, on YouTube, and then you can watch backlog. There are loads and loads of contents on my page. That just subscribe and leave us a comment, because the more you do that, the more people would want to, watch this and benefit from it. So if you think anybody can benefit from it, do well to leave us a comment, share it and like it, and go to YouTube, subscribe to our YouTube channels, and we look forward to bringing you more contents like this that will be very useful to you and very educational as well. So thank you very much for being here, and thank you very much for being part of today. You're very welcome, Suleiman. I really appreciate that. Thank you very much, and do enjoy the rest of your day. God bless you. Bye.